The following is a conversation with Rob Halligan and Scott Ashmore, co-founders of Shuttle, an Irish-based fintech company whose platform is allowing regular people to invest in early-stage companies, a world historically reserved for those with deep pockets and wide connections. Scott and Rob, thanks for joining us. Shuttle allows you to invest in select venture capital opportunities without the complexity or gatekeeping. For the benefit of those who don't know, perhaps explain what a venture capital opportunity is first, and then talk to us about the complexities and gatekeeping around these opportunities that made you want to start Shuttle in the first place.
Yeah, so venture capital, first of all, I guess venture capital is basically the funding of early stage companies. So think about Stripes or any sort of big company coming out of Silicon Valley. They started somewhere. Stripe started in Limerick. So they started somewhere. They needed money to get off the ground. So they seek people called venture capitalists, who are people that take bets on small companies based on an idea that they're eventually going to become a big company. So that's kind of where venture capital starts from. And that can be anywhere from a couple 100,000 all the way up to 100 million. So they fund the innovation of tomorrow.
And in terms of the complexities in gatekeeping, because I know you mentioned that on your site, where did you see that in your own experience in the field of venture capital, and what made you want to solve those problems?
Yeah. Myself and Scott go back nearly 25 years as friends before business partners. And we were, like many people here in Ireland and further afield, who were interested in shoring up their financial future, if you will. We were investing together in cryptocurrency, in stocks, in ETFs, etc. And because we were working in tech, and maybe as a result we're slightly closer to the venture capital scene, as most tech companies tend to be, or certainly ones that are somewhat successful, venture capital backed, we were interested in exploring, can we invest in early stage companies like this, in innovative young companies who are building tomorrow's technology. And we learned very quickly that opportunities like venture capital belong to a bucket called private market opportunities. So you have if you want to buy, stock on the stock market, they're public equities. So if you're buying, Google stock or whatever it might be, private market opportunities like venture capital tend to be reserved for the very wealthy or institutional investors. So we learned very quickly that there was a number of barriers that kept people like us out of that. And that kind of rubbed us up the wrong way. And we thought, surely everyone should get the opportunity to invest in stuff like this. This is potentially, higher yielding opportunities. I want to explore this too. I felt that we were financially savvy enough at that stage to explore opportunities like this, but we weren't able to get near it. And that's typically because of barriers like regulation, although that's softening now, thankfully, in a number of areas, including Europe. But probably importantly, closed networks and high capital requirements to get access to stuff like this. So that keeps the majority of people out.
So yes, there's definitely this sense of democratizing access to private markets. I suppose for these early stage companies, Shuttle to me seems like a lever that can be pulled to raise money to expand the business. Give us an idea of the types of companies that have raised money through Shuttle and how early those companies tend to be in their life cycle.
Yeah, so it could be an idea on a napkin stage. It could be all the way up to Series A, which is where they've, they're post revenue, they got some great traction. So there's definitely a big gap in between. Like, we fund the earliest ideas, and we fund all the way up to kind of Series A, later stage deals too. So yeah, there's a wide spectrum of opportunities that we would help get access to funding.
I think importantly on that, it really comes down to every company is different, right? So It comes down to, what is it that they're building? Who is the team behind it? Is the market attractive and big enough, to really create a great company in the space? And are what they're doing, novel? Are they approaching it in a different way? So does it look attractive in that regard? Yeah. So it doesn't, and for us, the reason that we're focusing on the kind of earlier stage of the I guess, the venture capital space, which is the kind of pre-seed, seed, Series A. For anyone who doesn't know, it's kind of they're like the first kind of funding rounds, institutional or serious funding rounds of a company, is because we see that there's the biggest opportunity, the greatest chance to, or the greatest opportunity for growth, right? So if one of these companies does go on to be successful and grow into a very large opportunity, the earlier you get in, the greater the upside. So that's where we want to play, and that's where we see the opportunity.
And in terms of those companies and the variety of ones that you have coming to you, how are those companies ultimately selected, and what does the due diligence process look like for your team?
Yeah. So we, first and foremost, we're only investing in companies, or we're only exposing our customers to companies where there's at least one venture capital fund leading the round. So in all cases, you will have a institutional investor outside of ourselves who is performing their own institutional level of due diligence on the opportunity, setting the terms of the investment. So far, we've had no less than 3 venture capital funds in each opportunity that we've invested in. We, of course, then do our own due diligence. So we've built technology on the back end of our platform to help us diligence opportunities that allow us to, again, like I mentioned earlier, look at things like who are the team behind this, what's their skill set, what's the opportunity, what's the problem that they're going after, the market that they're operating in, what's the solution that they're creating for that problem that they're trying to create, what's the direction that the business is going in. And we then grade the opportunity against those categories to help us better understand whether or not this is a worthwhile opportunity. We'll also pull in people from our own network, subject matter experts and people with differing expertise, whether they're venture capitalists themselves, but not aligned to the opportunity in any way, angel investors, operators, startup founders, etc., people from around the space that we can lean on for differing points of view to help us form a bigger picture of the opportunity. We also do, of course, like legal due diligence background checks on the founders and the accounts and everything in the opportunities as well. And we use all of that then to form an opinion on whether or not we feel that this opportunity is strong enough and on thesis for our customers and a good fit for the platform.
And a lot of that happens all through our platform. So we built proprietary technology that kind of gives a structured process, a formal process to all that. So we always have a record of what we've been looking at and how we've evaluated a company, and we can share that information with those external people so they get a kind of a holistic view of what we've been thinking about a company too.
So that process in and of itself is obviously very time intensive. There's a lot that goes into it. I would imagine there's a lot of looking at financials, listening to pitches, as you say, talking to your external VC partners. You guys are obviously a team of 2 right now. You've mentioned before we started shooting that you're expanding, 2 co-founders at the moment. How does that workload in terms of due diligence affect the quantity of investment opportunities that are available to users right now?
So I think in terms of quantity, the way that we've always approached it is that we're a quality over quantity platform. We're not trying to offer our users a large volume of opportunities. Now our goal is to allow them to build a really broad portfolio, take that indexed approach and have, as many shots on goal, if you will, so that you cast a wide enough net to catch those ones that do end up being successful, right? But we can't let quality fall off during that. So for us, it's about taking a smaller number of high quality bets. So we're only looking to maybe invest in 12 companies a year, roughly. And we do that across a drop. Currently, right now, we're looking at what we call a drop every quarter, and those drops might be 2 or 3 companies per drop. So we're never trying to go high volume, get lots of opportunities in here. It's about making the right choices and taking the right bets. So the due diligence effort is manageable because we're very selective on which ones we'll bring in, and we can have first kind of conversations quite easily. But if we don't get the kind of warm fuzzy feeling, if you will, from there. We're not going to progress it down further. And we take a holistic view of the whole thing. It's not just that first conversation. It's like, okay, what are they doing? What are they building? As I said, all those areas that we look at, who else is involved here, etc. So the DD ends up being manageable because we're driving them down the funnel to only have a couple of deals at a time, a couple of opportunities. And two, we're leveraging a broader network around us to help us with that.
Yeah, I think as well, like the earlier stage you go, the more important team is. So the majority of due diligence is actually just getting to know the team, because there's not a lot of financials to look at. There's not a lot of other things. There's not a huge amount of traction. So it's all about spending time with the team and getting a feeling of, is this a team that can really build a generational company and go on and do something amazing? So you need to spend time with the team to really kind of get that feeling.
So let's talk more about the investment process itself. So say I'm a user on the Shuttle platform. How do I make my first investment in these early stage startups, and is there a minimum or maximum amount that I can invest?
Yeah, so how do you make your investment? So obviously when you create your account, you'll create a digital wallet on the platform. You'll fund that every quarter. So it'll be topped up once per quarter. Like Rob said, we'll source those investments 2 or 3 per quarter. Once there's an investment that goes live, you'll have a couple of weeks to make your decision. So we'll present all the materials to you, investment memo, key investment information sheet. So you'll have all the materials you need to make an informed decision. Once you've kind of analysed the opportunity and you feel like you want to get involved, then you can just click commit, and that will automatically divert your funds from your investment account into those 2 opportunities. So if you're investing 300 per quarter, that will divide 300 divided by 2 into those 2 opportunities. So it's about, again, trying to help you build that diversified portfolio, not betting on one more than another. It's about putting the same amount into each company every time. That's what's going to give you the best chance of hitting one of those outliers, because what you think is going to be a great successful company might not be, and the one that you didn't think is going to be a great success will be. So it's about having a strategy in place that you can stick to over a long time.
And I think like what we're trying to do is to try and create that behavior in our user to align themselves to that strategy of investing a similar amount across opportunities, investing in a broad amount of opportunities, because people like to think they have insider knowledge because they worked in a space before, or they have, their friend worked in a space before or whatnot. But as Scott said, there's too many variables in the early stages. So what you think might be a great company might end up not working out. What you think was not going to be a great company could end up going on to be an incredible business. So it's about trying to create those behaviors in our user. And ultimately, it all comes down to building trust with the customer, right? Allowing them to, or I guess earning their trust through the work that we're doing. We want them to put their trust in us that we're doing all of that heavy lifting, all of that due diligence, all of that sourcing work to find the right opportunities. And for them to come in and know that and then, commit. And as a result, we have a very high commitment rate across our user base, across our investments, like over 90%. So I think that shows that they're putting their trust in the work that we're doing and are keen to get involved in each opportunity.
And just to be clear, so is there a specified minimum or maximum investment amount?
Right now it's €250 per quarter.
Okay.
So you top up every quarter, and that's 250. So €1,000 a year is the minimum.
Okay. If there are multiple companies included in a given drop, which you kind of alluded to that there are, if I'm a user and I'm assessing this drop, is it possible for me to just allocate my capital to one company in the drop, or am I required to spread my investment across every company?
The latter. Yeah. So again, it goes back to the behavior that we're trying to introduce, is that we don't want people to become overly concentrated in one opportunity or one bet. So by leaving it open for people to have that freedom, what you find is people start to funnel larger amounts into single opportunities, which ultimately restricts how quickly and how broad their portfolio grows, right? Because they're saying, I'm not going to invest in this one or these two, and I'm going to put all of the capital of this quarter into this one opportunity. And then that starts to compound. And over time, their portfolio is restricted in how fast it grows. So what we're trying to do, as I said, is trying to introduce that indexed approach, trying to get them to invest broadly, similar amounts across opportunities, to kind of just introduce a better investing strategy and give them a higher chance of hitting one of those outliers and reduce the risk of losing money.
Do you anticipate any pushback from users there though? Because I would imagine potentially you could have come across a scenario whereby a user is very passionate about one company in a given drop. And obviously if this feature is baked in where diversification is effectively required, do you envisage someone saying, hey, listen, I would actually love this to be opened up more and it should be left to the investor to decide how they want to allocate their capital?
For sure, people will push back, but it's what we felt best was for the platform. It's what we felt best for the consumer. There's great research done on this when it comes to like indexing. AngelList, a similar company, did some research a while ago, where at a portfolio size of about 50 startups, your chances of losing money drop to essentially 2.5%. So if you only have a portfolio of 10 companies, your chances of losing money are greatly higher. So the diversification really is your best friend. And not only does it decrease your chances of losing money, it also increases your chances of earning more money because you're giving yourself more opportunities to get into those generational companies. Like with venture, the returns are kind of asymmetric, which means the upside is essentially uncapped. So if you imagine you invest in 100 companies and one of those companies is a Stripe, the returns are just phenomenal. So those returns from that one company will offset all the losses for all the other companies you invest in. And that's called kind of the power law within venture capital.
To add to that, we have had customers come back and say, hey, I really like X. Can I invest more? I'd rather invest more. And we do open up our opportunity if people want to invest above what their typical quarterly investment is, that they can kind of top up manually and go in again if there's allocation available left over in that opportunity. We can allow people to do that. But again, as Scott said, it's really about trying to help people build that diversification in. That's kind of the fundamentals of the portfolio on Shuttle. It's creating that diversification as a foundation.
Okay. I want to look at the due diligence process specifically for the user. So you talked about the memo, the pitch deck, and the key information sheet that's provided. What is the scope of the work that the user has to undertake there in terms of researching, and would you describe it as a significant time commitment evaluating this investment decision?
No, we take all of the information, we kind of ingest all of the information from the founding team, and then we structure it by pulling out the most important, the most relevant information for the customer, for the user. And then we create that in the memo. That could include anything from like demo videos, from pitch videos from the founders, obviously the deck, information on the market, the problem, the solution and product that they're building, etc. Different investors have different views on this. Some people are really thorough, so they'll be the type to take everything in, ingest, go away, maybe do their own research off platform into the industry or the market or competition and stuff like that, and then make an informed decision that way. Some investors are quite the opposite, where they've inherently put the trust into us. And they said, well, I'm happy that this is an opportunity the guys have put work into diligencing and feel is a good fit. I think one thing that ultimately what we're selling is exclusivity. So access to opportunities you're not going to find elsewhere where there's institutional investors investing. And I think the fact that there's at least one, in our case, at least three in the deals we've done so far, institutional investors diligencing these opportunities, gives some degree of security to our investors as well, saying, well, there's these institutional investors making bets on these companies. I know that level of due diligence has already happened alongside Shuttle's. That's enough for me. It's a scale, and you have people, from one end to the other, depending on what they like. We try and give them as much information as possible. We also want to help them feel that trust in us. But depending on the person, they might decide, I want to go off and do more, or I'm happy to just hit commit straight away. So,
and the two documents, the memo and the key investment information sheet, they're very different documents. The memo is more like a high level, what we feel about the company, why we think they're great, what we think the risks might be. Whereas the key investment information sheet is very detailed, very technical document where you can get much more into the technical aspects of the investment if you want to.
Okay. You have described that the 4 problem areas that Shuttle is solving for investors in the venture capital space is time, knowledge, network, and net worth. Would you agree that there's a limitation to the extent to which the problems of time and knowledge can be solved for the investor, specifically because I would imagine the investor still needs to commit enough time to understand each opportunity, the market, the fundamentals, the founding team, and they need to have sufficient financial knowledge to begin with, or at least consult a financial advisor in order to carry out their due diligence appropriately?
I think it's not worth kind of stepping over the time it takes to actually get into these opportunities. So building the networks of people who are going to give you access to, really exciting opportunities that you wouldn't have access to otherwise, that takes a huge amount of time. And that's where we spend a lot of our time, is building those relationships that are going to give us access to those really exciting companies that have really competitive funding rounds and they're very difficult to get into. That's a huge amount of time that we put into getting access to those deals.
And I think on top of that as well, if you think about these opportunities are typically only invested in by insiders with the right networks or very wealthy people or institutional investors, right? 99% of people don't get access to these types of opportunities. The only way someone like us could have invested in a startup before would be through like a traditional crowdfunding platform, right? They operate on high volume, often questionable quality, or certainly differing quality. It can go up and down. That can take a lot of time and knowledge required to effectively sift through that type of information and find the great opportunities, because those platforms operate on volume. You're seeing a large number of opportunities that you have to sift through. You have to have quite a deep level of knowledge to go out on your own and effectively diligence those as well. So otherwise it just becomes blind betting, and that is just a poor strategy. You're looking at it and going, that looks like a cool company, or my mate mentioned that company before and I love their branding. And that again is where poor strategy ends up coming in. So we are trying to do away with that side of it. As Scott said, number one, it's at getting access to these really competitive opportunities that you're not going to find on those type of platforms, and alleviating the need to have that knowledge to diligence them as well is where we're trying to come in.
Let's talk about fees. So a €250 annual membership fee, which is around just under €21 a month, plus a 10% cut of any realized gains by the investor on their investment. How did you land on this pricing model?
We validated through market research. So we kind of went out and surveyed and interviewed a large number of investors who meet our ICP, our profile. And we asked them what would make sense to them and what the preference would be on this. And this is how we ultimately came up with the costs. I think in regards to our fee, I think it's actually very accessible. As you said, €21 a month it works out to get access to opportunities that ultimately, and access to an asset class that you won't get access to anywhere else, I think is very accessible. And also comes down to kind of when we talk about the success fee, that's kind of an industry standard piece as well in venture capital. Typically how a venture capital fund would operate is they would charge a management fee of roughly 2% per year on invested capital and 20% carry at the end. So we kind of took the data that we were able to collect from the market and the sentiment from the customer profile, and then looked at what's industry standard and how can we kind of blend the two to find the right balance.
I think it's important as well that the 10% fee is aligning incentives. Like, we're incentivized to make sure you get a good return because that makes sure we get a good return too. So it's all about incentive alignment.
And I suppose, how do you think about fees in the context of their general impact on your end users' investment returns over the life of a given investment? And is it an ambition of yours to potentially reduce fees in the future as you scale?
Fees are, I think, a couple of ways to look at this. Most retail investors are going to be used to brokerage platforms with low fees or no fees, right? And they might look at Shuttle and think, oh, well, that's vastly different. So, that doesn't suit my, strategy or whatnot. But they shouldn't be, it's not apples for apples. They're two very different worlds, going from public market platforms and the assets that you can invest in to private market asset classes like venture capital. Two very, very different worlds. And access is black and white, right? So it's important that we look at it that way as well. You're paying for access to an exclusive asset class that you're not going to get access to elsewhere, with potentially uncapped upside on some opportunities if they do work out. So it's important to look at it that way first and foremost. The other side of it as well is, if you look at what you're trying to achieve, like we've had conversations with some investors before who have said, well, it doesn't make sense, how much would I have to make to break even on the fees? So if you take into account, if we have an investor who invests the minimum amount, 250 per quarter across, say, 5 years, so they're investing $5,000 across, plus taking into account a 10% success fee. So I don't think it's that unreasonable when you break it down and think of it long term. And we are talking about long term investments here as well. These are long term investments where your money is locked up for a long time. They're not assets that you can get in and out of daily like you can on public stocks. So it just takes a different outlook, I think, and a different perspective.
If the minimum investment amount is 250 per quarter, which is about obviously €1,000 per year, would you say it's a fair assessment to say that Shuttle is best suited to individuals who have the cash to invest a sufficient amount of capital to justify that annual membership fee of €250 per annum? For example, like if I'm investing the minimum amount of €1,000 per annum, my membership fee as a percentage of invested capital would be 25%. But if I'm investing, say, €50,000, all of a sudden it's 0.5%, which is a lot more palatable. So would you agree that it's probably best suited to those who have those cash reserves?
I think in terms of who this is for, it's not for someone who's betting €10 on stocks, every month or, every week or whatever it might be, very, very low scale investors. It's also not necessarily for high net worths. We're looking at that kind of middle ground, what we would consider high earners, or people who would probably fall into that mass wealthy bracket, if you will. So, and importantly, probably people who have some exposure already to the markets, right? People who have already been investing in public market equities, potentially cryptocurrency, etc., and pension, and are looking for exposure to potentially higher yielding, higher risk opportunities to build in some more diversification into their portfolio.
Yeah, it's probably important to mention that this is high risk, high reward asset class, and this should not take up a huge portion or stake in your portfolio. Like anywhere between 10 20% is 20% at the very high end, but around 10%. So you can do the maths with that to figure out where you should be investing the money.
Well, let's stay on the topic of risk. Like as you say, Scott, it goes without saying that investing in early stage companies is a highly risky endeavor. Illiquidity and dilution are two risks in particular that I'd love to hear your perspective on as they relate to the investment opportunities on Shuttle.
Yeah, I mean, dilution is one of those things that affects everybody. There's no getting away from it. It's just a fact of life. It happens to everybody, not just individual retail investors, but institutional investors face dilution too. So it would be baked into a lot of models, would be baked into all models that any kind of institutional investors would look at. So you can think of, and it depends as well, how many funding rounds a company goes through. And I think it's exciting.
Sorry, perhaps just explain dilution as well, just so for people who aren't aware.
Yeah, absolutely. So dilution is when you make an investment and then the company goes on to raise more money. That company will have to issue new shares. So that means some of your shares will be diluted. So if you held 100 shares worth €1 each, and that company goes on and raises another funding round, those shares might become worth 70 cents each because the companies had to issue new shares. So yeah, dilution is something that affects everybody. And depending on how many times a company raises further rounds of funding, the more you'll get diluted. But I think what's exciting at the moment is kind of the introduction of AI, and companies can scale faster with less funding. So that means there's less funding rounds needed in the future. So hopefully dilution becomes less of a factor these days, but still everybody faces dilution, and kind of all financial models have dilution baked in. So for an example, if a company goes through a pre-seed where we invest and they go on and raise a series A, B, C, you can think about dilution as around 20% each funding round. Your position will be diluted by about 15 to 20%. So you can kind of work it out that way. But yeah, dilution is just one of those facts of life. And I don't know if you want to talk on the liquidity.
Well, just on dilution, I think it's important to note as well for anyone, what we mentioned is that your shares will be worth less, but the point is that the company will be worth more each funding round. So even though each individual share is less, the overall portfolio is increased in value, right? So even though your stake has shrunk, if you will, the actual value of that stake has increased, right? So even though dilution happens, the value is still increasing each time. So that's important to know. And the other thing as well is, what we'll always look to do is have an opportunity to reinvest at a future round, right? So what investors typically try and do is, if they invest, say, in an early round, is that they can invest again, right? It might be baked into the terms that they can invest in the next round to try and true up the percentage of ownership and try and keep that percentage of ownership, right? So we'll also be looking at those opportunities. Doesn't make sense for us to try and invest in a future round to maintain ownership if it's a great company that's really growing. So we'll look at those opportunities as well strategically also. The other piece on liquidity is, and it goes back to the percentage of your portfolio that should be aligned with things like venture capital, right? Venture capital startups, they're an illiquid asset class. Unlike, buying your Google stock, which you can sell a second after you buy it. Once you invest in startups, that money is locked up until there is an exit event. An exit event being an acquisition, a merger, an IPO, or if there's an opportunity to sell your shares in a secondary transaction down the line as well. So you have to be willing to allow that to happen. There isn't going to be an opportunity to get that capital back in the middle of that period if you need it, right? So it's about only investing or only aligning a certain portion of your portfolio to this, where and you're willing to allow that capital to go to work for a significant amount of time. And typically that could be 3 to 10 years, right? 3 years on the very low side, but usually between 5 and 10 years is kind of the life cycle of a company from launch to exit, right? So you have to be willing to say, okay, I want to invest in these opportunities because of the potential upside and the potential yield. But if whatever I'm putting them in, I have to know is gone for a considerable amount of time, and I'm willing to let it go to work for that amount of time as well.
I think good to mention as well, like thinking about illiquidity as a feature, not a bug, because we're humans and any sort of market volatility can leave us making decisions that we might not have made otherwise. So if there's not an option to sell and you go on and it becomes a better return in the long run, that illiquidity has really played in your favor.
Mm-hmm. So I suppose the overarching message is that if an investor is going to be going into this, they need to be going in with the mindset that at a bare minimum, it's unknown as to when they'll receive a return on investment or a return of their invested capital. But bottom line, they may never receive a return because it's a highly risky endeavor.
Absolutely. And again, that goes back to the indexed approach to building a broad portfolio, because no matter how great a company looks, how skilled and experienced their team is, how amazing the technology or product that they're building is, there's so many variables and uncontrollables that many great companies don't make it. We expect that over the course of the next several years, as we invest, companies that we invest in, even though we're making decisions on them that we think they have what it takes to go the distance, as I said, some will fail for reasons unknown, right? So we have to expect that. And that's why we're trying to take that broad approach of building out that broad portfolio, because some of your portfolio might not make it, or some of them might end up creating flat returns or very low returns. But the point is to cast the net wide enough to catch those ones that go on and go 10, 20, 50, 100x plus, and that pay back the whole portfolio.
Talk to me then about the tool on your website. I was having a play around with it last night. Effectively, it's comparing the hypothetical return of an investment in venture capital to the hypothetical return of other asset classes, most notably the return on investment of an investment in the S&P 500. And the tool would seem to suggest to users that venture capital investing has the potential to provide returns in excess of index fund investing. And you do rightly preface that by saying that past performance isn't indicative of future results. But would you agree with that assertion that venture capital investing actually has a practical chance of outperforming index fund investing, like with the S&P 500?
Absolutely. Of course it has a chance of outperforming the S&P 500. But again, it all depends on getting into those outlier companies. And again, that comes back to the indexed approach. But if you do build that broad portfolio and you do end up getting into one of those great companies, then absolutely, the chances you can outperform the S&P 500 are significant.
And what data is being used to, I suppose, generate those hypothetical returns of investing in venture capital?
So all based on historical data over the past 20 years, whatever the S&P 500 returns are, but also Cambridge Associates Venture Capital, they're kind of US-based returns over the past 20 years too.
Okay. So I think my main challenge, I suppose, to that assertion that, you know, the possibility of outperforming index funding with venture capital is a practicality would just be the data from the likes of, you know, the S&P Global SPIVA scorecard, which like measures the long-term performance of actively managed funds versus passively managed funds. And many of us know that roughly 90% of active managed funds, which are ran by professional fund managers with the best technologies, fail to outperform index funding over the long term. And we've obviously talked about how, I suppose, the intention here is for these investments via Shuttle to form part of a long-term portfolio. With that data from SPIVA highlighting that on the average 90% of active funds underperform the index, I suppose, what would you infer from those findings, and how would it influence your messaging to prospective users?
A lot of VCs' game is picking very, very few concentrated bets on startups. So they're not taking that indexed broad approach that we're looking at. Their game is to use their skills, their knowledge, their team, whatever, to make really small number of very concentrated bets on companies. So their chances of hitting those outliers are significantly reduced. But the data shows that the indexed approaches that can actually and often will outperform many of these well-known VC funds because you're taking that broader approach to your portfolio construction. So going wide and casting a much bigger net, and that's exactly why we're doing it that way. We're not trying to be one of those VCs taking those concentrated bets. We want to give our customers as many chances as possible to lock in those returns.
I think it's an issue in VC, but it's also an issue in like actively managed public market investors too. Like every asset manager seems to think they have some godlike ability to pick the best companies. They all think they're amazing pickers, but ultimately, like as you said, 90% of them fail to return, capital. So it's that concentrated approach just doesn't work for most people. So
for us, it's about going wide enough, but also getting access to good opportunities. Yeah. So it's twofold. It's two sides of that coin, right? So that's why we're only looking at venture-backed opportunities where we have institutional VCs investing in these companies that we're co-investing alongside. And then two, unlike many of them, we're going broader and building a portfolio and taking that indexed approach.
You can tell me whether or not now this is a fair comparison or a fair parallel, but I did find myself drawing parallels between Shuttle and almost the ethos or culture that's kind of at ARK Invest, which is the investment management company run by Cathy Wood in the States. And that firm is, I suppose, all about investing in disruptive innovation and offering investment products like ETFs that specialize in disruptive innovation. And they actually have a VC fund that you can invest in too. And I suppose whenever the conversation about, the concentrated bets and the big winners of tomorrow, as you kind of mentioned, comes up, I am reminded about the two morals from Benjamin Graham, who was Warren Buffett's mentor. And I'll just read it out here for you. He has two kind of guiding principles with respect to this idea of picking the winners of tomorrow. He says, obvious prospects for physical growth in a business do not always translate into obvious profits for investors. And the experts do not have dependable ways of selecting and concentrating capital on the most promising companies in the most promising industries. So if I was to apply that here, I would say two things. I suppose number one, even though a company listed on Shuttle may have obvious potential for growth, that by no means guarantees a return on investment for the investor. And number two, despite the best intentions, neither yourselves or your VC partners can reliably allocate capital to these companies in such a way as to maximize the upside from the winners and minimize the downside from the losers. I suppose just hearing those morals from Graham and that, I suppose, observation around how it applies here, would you say that that's a fair assessment?
Yeah. I mean, I think it just speaks to what we've just been talking about for the last kind of 10 minutes. 100% in agreement with that. And again, it's exactly why we take this indexed approach on things.
Yeah.
Because we know we're not the best pickers, and we know the partners we work with aren't the best pickers.
Because that you can't be, right? There's just as I said, there's too many variables, right? Great companies fail. Companies that early on did not look like they would go on to do well, go on to become generational companies, right?
I think there's a great example of that. Brian Chesky in Airbnb. He's like very public about all the VCs that said no to him. So like that looked like an uninvestable company. It looked like a silly company, but look how it turned out. So people just don't know who the winners are going to be at that early stage.
Yeah. So it's about doing the work to make sure that you can get conviction around a company based on the data that is available, and then doing the extra work, like what we're trying to do in that indexed approach, that broad portfolio, to make sure you're covering yourself, right, for the chance of those ones that even look great that don't go on to do well, and still casting that net wide enough.
Yeah. And I suppose being transparent with your users that you aren't claiming to have some sort of crystal ball around these opportunities. They've just met your own internal standards. And now ultimately it's up to the investor as to whether or not they feel that particular opportunity meets their own capacity for risk.
Absolutely. And it's an educational piece as well, because this is a new space for a lot of people. It's like bringing them on that journey, help educate them on the asset class, help them understand that. And like, as I said, and Scott said earlier, it's that piece of research, that AngelList did on portfolio construction. And when the more companies you add, how significantly your risk is reduced. I think, as you said, when you hit 50 companies, chance of losing money reduced to 2.5%. So it's like, how can we get our customers to that position?
Okay. Let's move on to, I suppose, everyone's favorite topic, regulation. Anytime a new investment platform crops up, especially one that's operating in a niche like venture capital, the question on everyone's mind from the outside is this safe? And I know Shuttle is regulated by the Central Bank of Ireland. So to you, what does that regulation piece mean for your users in terms of safety?
Yeah, well, obviously I think it's trust first and foremost. Like, we've gone through a 2-year process getting regulated by the Central Bank of Ireland. All our policies and procedures have been developed. We've got an amazing policies in terms of our governance, how we run things, and that's all closely watched by the Central Bank of Ireland as well. So everything we do is in the best interest of the customer. We try to bake a huge amount of trust into our platform, and just to make sure that no stone is left unturned in terms of how we're approaching interacting with our consumers. How do we make sure that our products are suitable for those people? Like, every customer goes through suitability assessments when they join the platform. So it's really all about delivering trust for our customers. That regulation enables us to deliver that trust to those customers. Yeah.
I think I think the benefit of, when we started out down the regulation route, there's opportunity to get regulated if you're domiciled in Europe. You don't have to get regulated by the regulator of the country that you're domiciled in, right? It doesn't have to be the CBI. We could have gone to anywhere in Europe to look to get authorized. You take someone like Revolut, who got authorized in Lithuania, and some people say that was kind of an easier route into the market for them to start, right? We got authorized by the CBI because we're Irish and we're based in Ireland. We just thought that's the thing to do, right? That was probably like a naive thing in a way. But the benefit of that to our customers is that the CBI are probably the most conservative regulator in Europe and considered the rubber stamp regulator in Europe as well, hence why companies like Revolut want to get regulated here. So the level of scrutiny that goes into the application and what we're building is incredibly high. And hence why it took us such a long time to get through that regulation period. Our application phase was a year. It was nearly another year to then go through the post-application scrutiny before getting licensed. And that's because the level of detail that goes into the application and the review piece is so high. And while that was kind of frustrating at the time because we're, chomping at the bit to get operational, now we can look back and say that's a great thing for us and for our customers, because trust being a core value of ours, that's what we're trying to show, and having that rubber stamp of approval from the CBI behind us is super important for that.
It's a very valuable differentiator for your business. Many investors who have used other investment products and deposit products will be familiar with the deposit guarantee scheme and the investor compensation scheme. Could you clarify whether either of these protections are available to Shuttle users in any capacity?
Unfortunately not.
No.
Okay. And is there a particular reason or rationale for that people need to be aware of?
It's not part of the regulations. It's not baked into the regs to have that. It would require a credible amount of resourcing and capital to be able to provide something like that.
And then just on the deposit guarantee scheme, we work with a third-party payment service provider. So all the funds that go through our platform are safeguarded. So if Shuttle went under for any reason, then all those funds are still secured by the third-party payment service provider, and they would be using the deposit guarantee scheme as well.
Yeah, so there's layers to how we've structured the business so that there's separation between the Shuttle business, the customers, and their capital as well. So if Shuttle, ceased to exist tomorrow, all of a sudden, those investments and that capital is totally segregated away from our business.
Because that was going to be my next follow-up question for you there, Scott. So I was going to ask about the custody chain. So the non-invested cash deposits that are held with your third party, in the event of that third party's failure while they're holding the cash, they would be covered by the DGS deposit guarantee scheme. In terms of the investments themselves, so the actual shares that the user assumes when they invest, how are they held?
Yeah, so we work with a third-party nominee company, and they hold all the shares for the beneficial interest of the underlying investors. So again, that's a third-party company we work with. So for any reason, if Shuttle went under, all the shares are still held on trust by that company.
And if that company who holds the investments, if they fail to safeguard those investments, is that company covered by the investor compensation scheme?
I'm not 100% sure, but I think in that situation, we would just give the users direct ownership of the shares. So for any reason that company was looking like it was going to go under, we would just transition all the shares into direct ownership with the investors.
And that third party as well is a well-established provider of wealth services across Europe. So they would have their own safeguards in place as well for situations such as that. But in a situation like that, it's a little bit easier because we're just talking about share certificates, so we can just pass that ownership straight through to the investor.
Yeah, because I think we'll get onto the technology now in a second, but I think with investing platforms, there's a tendency for users to maybe underestimate how much goes on in terms of the custody chain and where cash is held and where investments are held and what happens in different circumstances. So it's always just good to get that clarity.
Yeah.
So on the technology, all of us are guilty of having a tendency to take these sleek and seamless investing experiences for granted, often to the annoyance of the developers who have to make them. What does it take to deliver a platform like this from a technological development perspective?
I guess the benefit of going through that authorization process with the central bank gave us a lot of time to build the platform, and we didn't work with any external companies. It wasn't sold out to any kind of third-party developers. Like, we built it all in-house, built it myself, so had a lot of time to really finesse the platform and work with a lot of really trusted user experience designers, user interface designers, animators. So yeah, we had the benefit of time going through the authorization process to really focus on building that unique user experience and really interesting user interface and beautiful user interface.
I think there's kind of a couple elements to it, because there's the what the customer sees, right? And for us, we try and build technology where it's about, can we remove stuff instead of adding more? Because it's about the user experience. How can we make it incredibly simple, clean, smooth, beautiful, enjoyable to use experience? So we're really, really deep on how we build the technology from that perspective, the user experience in the front end. And then it's about, like we mentioned, third parties. It's like, how can we leverage regulated, established technology that we can plug into to support the back end functions of our business, right? Because if we wanted to do it all, we would have to go out and get regulated as a payment service provider and all sorts of stuff, an e-money license. You know, you'd never get around to doing all of that stuff. You'd be forever building, you'd be ever in the regulation space before you actually ended up building anything or getting authorized. So for us, it was like, how can we pull in the right partners that have built the technology to manage the flow of funds and the segregation of capital, and that are regulated and established, so that we can leverage that technology and the right people. So again, as Scott said, the benefit of going through an authorization process is that it gave us a lot of time, which was hard to recognize at the start as being a positive, but it meant that we really were able to go deep on building the right technology. But it takes a lot of time and pain.
Yeah.
Because I suppose you had your own non-negotiables that you wanted to bring into your development process. Maybe tell us what those non-negotiables were and how they changed, or you were forced to add new ones as you went through that regulation process.
I think one of the biggest, sorry to cut in, I think one of the biggest one was just like when it came to friction for the user, when it came to like terms and conditions and like going through the investment process. Yeah, at one point we were being kind of nudged towards every investor having to like take lots of documentation, make lots of signatures across lots of different documentation. And for us, we were just like, that absolutely cannot happen, because it's just introducing so much friction, so much time sink for that user. It needs to be completely condensed and simplified for that person, so that the information is there should they want to go in and review it at any time. But to actually get through it has to be incredibly simple, one action to make that happen. So provide them with everything that's there, provide them with the information, but give them the ability to get through that incredibly quickly and simply, right? So that was one element of it, and I think there was probably a few bits of like that.
Well, I think with the benefit of time, like, we learned about not building any feature for just the sake of building a feature. For something that looks cool doesn't mean it's cool. So it's all about building features that are really geared towards the customer, and how is this feature going to add value to this customer? And if it doesn't add value in a meaningful way, then it's not worth spending time on it. So everything has to be taken from the viewpoint of the customer. What is this change going to add value? How is this change going to add value to the customer? And if it doesn't add change in a meaningful way, it's not worth pursuing.
It's very easy to get like, when it's just, when me and Scott or any team are together building, it's very easy to think this will be a great feature, and you're like adding more because this looks cool and I think people will want that. And then you end up with this like bloated platform. And I think what you see, I think like 10, 15 years ago, when public market platforms had their kind of, their intro day, and there's loads of them now, they've, over the last decade, a lot of them have grown quite clunky and bloated and convoluted, because they're trying to be all things for all people. An opportunity for, if you think about any public market investing platform, I won't name any, but you go on, there's products for every type of investor, right? And the problem with that is it becomes very clunky, it becomes convoluted, it's hard to navigate, there's lots going on, and the aesthetic takes a bit of a nosedive. So, and that will happen as a company grows, because you do have to innovate and add more, like, naturally. But the hardest thing to do is to reduce, right? Or to not build or not introduce something, even though you think it's great and you think it's cool or you think it might be necessary. Doing the work to like really validate, is this going to be a needle mover? Do people actually care about this? So for us, it was like, let's only introduce something if we like really know it's necessary, and have it like simple. When I say simplicity is a value of ours, I mean like we try and live by how can we make this as simple as possible. And that was really about going to people, getting out of our own heads and asking people literally to come in and review and be as mean as possible. Like, really tear this apart and like, don't worry about our feelings here. You need to tell us as it is, like, is this valuable? Is this worthwhile? Or are we wasting our time here? And just using those opinions to drive.
If I am a user and I'm looking to simply track the performance of my investment? Is there such a thing as unrealized gains being presented? Are there reports to assist with tax filings when I eventually do sell in the future? If an exit event happens, is that all available?
Yeah, so on the platform, and obviously the liquidity of these means they're not being constantly marked up in terms of their value. But whenever a company does raise a subsequent round of funding, that'll be updated on our platform. So any time a company's value changes, that'll be reflected in the person's portfolio page. In terms of the tax, it's not something we do at the moment, but definitely in our plans for the future to help people kind of figure out the kind of tax burdens they'll have when they do make a return on these investments.
Yeah. Not something that we've had to bake in from day one, because obviously the long-term nature of these investments and the liquidity of these investments. But absolutely, I'd say by this time next year, we'll have that information readily available to people. So should there be an exit event, they'll be able to act accordingly in regards to the tax.
On the topic of tax then, specifically for your Irish users, are there any tax advantages or reliefs available for investments made via Shuttle? Because I know people will be asking about EIS in particular.
Yeah. So the EIS thing is really on a case-by-case basis. It's not up to us to determine whether an investment will be where people can take advantage of the EIS scheme. It's up to the founders of the company and whether or not they're raising under that scheme. So founders will have to get certified as being EIS compliant, and then they'll have to notify investors that they're raising under that scheme, so investors will be able to take advantage of that tax break. So it really comes down to it will be on a case-by-case basis. We envisage that some founders will and some won't. The first Irish company that raised through the platform didn't. I think there'll probably be less companies that take advantage of it, because I think there's some burdens on the company if they do raise under that scheme that probably aren't ideal for the founders. So, and naturally the opportunities that we're going after are competitive opportunities where founders might have many investors trying to get access to their deals. So we're there on that side, and they're in that kind of position. They might not have to take advantage of the scheme, if they might not need to. So again, I think there probably is likelihood that there will be at some point, but possibly few and far between.
What's the grand ambition with Shuttle? What's the North Star? Where do you want to be in 10 years? How do you want to shape the industry? How do you want to change private equity investment?
I think, do you want to go ahead?
Are you good?
I think we're standing on a pretty seismic shift that's going to happen in the markets towards private market opportunities. Regulation softening both sides of the Atlantic, more products opening up to allow retail investors to invest in private market opportunities. Retail investors own 50% of global wealth. Their allocation to private market opportunities is set to grow by more than 300% over the next 7 years, from $4 to $13 trillion. All of the giant asset managers around the world have taken notice of the retail channel as a great source of capital for their operations, and are now shifting focus both from a product perspective and a regulatory perspective to be able to capture some of that value. But the majority of those are still focusing on the high net worth end of the retail channel, the wealthier end of the retail channel, leaving the kind of mass wealthy segment of the retail channel unserved, right? So for us, I think there's an opportunity to kind of redefine how wealth gets built in Europe over the next decade, and we want to be at the front and center of that movement.
Yeah, I think good to note as well, just in terms of the macro of private markets, public markets, like in 1980, I think it was, there were 8,500 public companies listed on US stock exchanges. Now there's 4,000. So like 43% decline, or more than a 50% decline. And as well, companies are now staying private longer than ever before. Look at Stripe, it's worth 90 billion, it's still private. Google went public at around 600 million valuation cap. So more and more companies are staying private for longer and longer. They're staying within the private markets. And that means by the time a company does go public, so much of the upside has already been captured by institutional investors and ultra high net worth individuals. that there's just less upside to be captured in the public markets. And I do, like Rob said, I think there's going to be a huge shift from retail, from public markets into private markets as that access is created in a way that actually appeals to retail investors. And I think we've got a great opportunity to kind of build that infrastructure and that distribution.
I think some of the more mainstream ones that people will be aware of is, like SpaceX and the holding company of TikTok, and even some like legacy companies, like I think Riot Games are still private. So there's tons of examples of companies who have commercially done very well, but you haven't been able to invest them from the public sphere. So having these opportunities is certainly beneficial. You both have young families, and you're both lucky enough to be working as a team of two with co-founders. How important and influential has, I suppose, those support structures been to your success so far?
Everything, to be honest. Like, you're not just, I think first, like, we're fortunate that we're being friends for nearly a quarter of a century, because trust was never a question. It's inherently built into the relationship already. So much of the kind of like dating stage that founders often go through, who might not have known each other that well beforehand was not a thing. So that made things a lot easier. But when you go out to build a company, it's not just us. Like, our partners are pulled along, our kids are pulled along. They feel all of that as well. They feel the stress and the strain, the lack of money in the household because you're not paying yourself, or you're paying yourself very little, and trying to create something new, trying to build something of your own. So they feel all of it without all of the context, which is really difficult, right? Because they see the struggle of it all, but they might not necessarily have all the detail around it because you're in it day to day. So that having that support, and I'm glad that our families are close and know each other so well, because it makes things a lot easier. But yeah, without my wife and kids kind of are the reason that we're doing this, right? And I know I speak for both of us when I say that. So having them behind us is everything. And I think when I decided that I wanted to do this with Scott, I think my wife said to me, she was like, well, if you don't, I'll never hear the end of it. So you better go and do it now while you can. So I think that was probably rang true.
Yeah, I think we're just so incredibly lucky to have the support we have, but also so incredibly lucky that we have kids the same age. Like, we get together every weekend, the kids get together, the kids are friends. So like, our partners are like living and breathing this together with us. So there is a support network there. It's not just myself and Rob in this isolated. We're all going through the same thing, and our kids are friends. So it's just really nice to be able to get together on the weekends and forget about business and just be present with each other. So yeah, I think we're incredibly lucky in that regard.
You both have been working, I suppose, in some degree in the Irish startup community for 4 or 5 years now, around that. It seems like every day there's new companies and new startups cropping up, which is great. I suppose if you had to give one piece of advice each to an aspiring entrepreneur in Ireland today, what would it be?
I would say be very careful with what advice you listen to. I think me and Rob went through this in a big way. We listened to advice from everybody and anybody who was willing to give it when we started out. And that's what led to us building the wrong things, building things that didn't matter. And eventually that led to us pivoting the company a couple of years ago. So I think it's great to get advice, but be really think about the advice you're being given. Because at the end of the day, nobody knows your company better than you do. So just take every piece of advice you get with a grain of salt and make sure you're building the right things that your customers actually want.
Mm. The other thing I'd say is it's every day you go through like a full spectrum of emotions, almost by the hour. You'll be tested more than you'll ever think you could be. Having somebody along with you is for the ride, like a good co-founder, is incredibly important, because there'll be days where you're just questioning it all and wondering, what am I doing? So be prepared. Number one, have that support structure around you. Like, it's so unbelievably important. But be prepared to dig deep and be more resilient and gritty than you probably thought you could be, because you will need it.
Last question, how can people find you?
Yeah, we're at shuttle.club is our URL. And you can join our waitlist from there. We're getting ready to open up to our third drop in the next few weeks. We're also on LinkedIn. We love speaking to anyone who's remotely interested in what we're doing, or just wants to, discuss venture capital, private market startups. So you can reach out to us there as well. We're keen to chat with anyone who might be interested.
Scott and Rob from Shuttle, thanks for joining us. Cheers.
Thanks, Dan. Appreciate it.
Cheers. Good.